Okay, here in this video, we're continuing our discussion of ARC Section 90A for the review of financial statements. And in this particular video, we will discuss how we should modify our accountant's review report if there are known departures from the applicable financial reporting framework and the financial statement. So if we did all of our procedures and we saw that an account or a disclosure was materially misstated, then we need to disclose that and other matter paragraph. So this is ARC Section 90A.56-60. And so it says that when we become aware of a departure from the applicable financial reporting framework, and that includes inadequate disclosures that are material to the financial statements, and if the financial statements are not revised, then we should consider whether modification of the standard report is adequate to disclose the departure. And if we do decide that disclosing it in our accounts review report is adequate, then that departure should be closed in a separate paragraph of the report under the heading known departures from the applicable financial reporting framework that we're using. So either known departures from generally accepted accounting principles or the tax basis of accounting, whatever financial reporting framework we're using. And if we've determined, or if management or we has determined the effects of that departure on the financial statements, then we should disclose that as well. However, if the effects of that departure have not been determined by management, or we weren't able to decide on the effects of the departure, we as the accountant are not required to determine the effects of that departure. We can just state in that paragraph that the determination of the effects has not been made. And so this was all if we determined that the departure from the financial reporting framework was adequate. We just add a disclosure just to notify the user of the financial statements in the accountant's review report that a certain item departed from the financial reporting framework that we're using. But if it turns out that we believe that the modification of the report is not adequate to indicate the deficiencies in the financial statements as a whole, then we should withdraw from the review engagement. So basically our conclusion is going to state that we were not aware of any modifications that should be made to the financial statements except for this item that has this effect on the financial statements. But if it turns out that this item or the combination of a lot of items turns out to be very material and have a very big effect on the financial statements and make them pervasively misleading, then we need to withdraw from the review engagement altogether rather than make an extra paragraph in the report as we're stating here. And we should not modify the standard report to include a statement that the financial statements are not in accordance with applicable financial reporting framework. So our steps here, I suppose, would be that at the end of the review engagement, we would figure out the known departures from the financial reporting framework that we found in our review procedures and ask management to revise those. And if management does not revise the departures, then we need to decide how material are those departures to the overall financial statements as a whole. And so if it turns out that the departures that we found can be discussed in another matter paragraph, and that would be sufficient for a user of the financial statements to understand that departure and to make their own decisions based on the financial statements, then that would be appropriate. But if we're unable, or in our professional judgment, we don't feel like that paragraph is enough to make it known to users of the financial statements the pervasiveness or the impact of that known departure and making the financial statements as a whole basically misleading to users of the financial statements, then we should withdraw from the engagement. And never should we say in our accountant's review report that the financial statements are not in accordance with applicable financial reporting framework. So if we decided that this paragraph is not sufficient and adequate, we can't, in our accountant's review report, say that based on our procedures, we found that financial statements do not be in accordance with applicable financial reporting framework. We instead need to just withdraw from the engagement. Okay, so we've got some explanatory material here, so we can go down and get some more understanding on exactly how to go about this. But we've got A104 and 106 through 108 and 109. So basically 104 through 109. So let's take a look at those sections. Okay, so here we're down in the explanatory material section, where it gives us some more information on how to disclose in our accounts review report known departures from the applicable financial reporting framework. So here it gives us a few headings that we can use for the paragraph where we would discuss the known departures if we decided that the paragraph is adequate for disclosing it. And remember it has to say known departures from and then the applicable financial reporting framework. So that's how each of these examples is structured: GAAP, cash basis, tax basis, IFRS. And next they suggest to us that if we decide that the known departures are so pervasive that a paragraph would not be enough for disclosing them, then we are required to withdraw from the engagement. And so this paragraph suggests that we consult with legal counsel before we do that. And here they explain to us why we can't say that the financial statements are not in accordance with the applicable financial reporting framework. And that's because that would be the same thing as us expressing an adverse opinion on the financial statements, which is an audit opinion. And we're not doing an audit, we're doing a review. And also it might confuse users of the accountant's review report because it would contradict the statement that's required in paragraph 39F, which we saw in a prior video, which says that we are required to say in our conclusion in the accounts review report whether we were aware of any material modifications that should be made to the financial statements for them to be in accordance with the applicable financial reporting framework. And it doesn't say whether that we're required to say whether the financial statements are in accordance with the financial reporting framework. They say that we're required to say whether we're aware any modifications should be made for them to be in accordance. So it's a very different conclusion. And next, this paragraph tells us what to do or suggests adding an other matter paragraph in accordance with 52 through 55, which we discussed in a prior video. But depending on our assessment of the dollar magnitude of the effect of the departures that we found, or the significance of the affected items to the entity, or the pervasiveness and overall impact of the misstatements, and whether a disclosure has been made of the effect of the departures, then we might include this paragraph here after the conclusion, or after the emphasis of a matter paragraph related to the departure. And it could basically alert the users of the financial statements that because the known departures, and we can refer to the prior paragraph, because those departures are so significant and pervasive, we were unable to assess their impact, and that users of the financial statements should be wary of that fact and understand that their opinion of the company or the performance or the results might differ if the financial statements have been in accordance with the applicable financial reporting framework. So next, they say here that inclusion of the separate paragraph, the emphasis of a matter paragraph, that discusses the known departure is not a substitute for disclosure of the specific departure or the effects of the departure if management has determined them or they're known by us. So we should do everything we can to have management determine the effect of the departure on the financial statements, or to maybe try to determine it ourselves so that users of the financial statements can be aware of how to view that departure. So finally, down here at Exhibit C, we have some illustrations of some accounts review reports, and some of those include the paragraphs for known departures from the applicable financial reporting framework. So let's go down to Exhibit C and take a look at a few of those illustrative accounts review reports. Okay, so now we're down at Exhibit C for illustrations of the accounts review report, and let's see if we have one discloses a known departure. So this one here, illustration 5, disclosing a departure from generally accepted accounting principles. Go down to illustration 5 to see how they disclosed this departure. Here we have illustration 5. The financial statements contain a departure from GAAP, and we have everything here is normal. Our responsibilities, management's responsibilities, accountant's conclusion. And we see here that it says, based on our review, except for the issue noted in the known departure from accounting principles generally accepted in the United States of America paragraph, this one. So except for the issue here, we are not aware of any material modifications that should be made to the accompanying financial statements in order for them to be in accordance with GAAP. And so then after that conclusion, we have this other matter paragraph that explains the known departure, and they give us a couple of examples here. And this is actually an emphasis of a matter paragraph because they refer to a footnote here. So as disclosed in this note to the financial statements, GAAP requires inventory costs consist of these items, but management informed us that the finished goods and WIP is stated with materials and labors only, so it didn't include overhead. And so that's a departure from GAAP. And they also noted here that we weren't able to, or management did not determine the effects of that departure on the financial position, results of operations, or cash flows. For the second example, the departure was a change in accounting principles. So, say as disclosed in this note to the financial statements, the company adopted a new accounting policy. The previous accounting policy was this, and although the new method is in accordance with GAAP, the company didn't have a reasonable justification for making that change, which is required by the ASC 250. So these are a couple of examples of what to include whenever you're explaining a known departure from the financial reporting framework. And then just like the other reports, we've got our signature, city and state, and date. So